Nigeria's banks are juggling growth and pressure in 2025. Assets are on track to hit 242.3 trillion naira by year end, yet profit before tax is projected to fall by almost 20% compared to 2024. With the central bank ending regulatory forbearance, banks must now fully account for non-performing loans, pushing the industry's impaired loan ratio toward 7%. At the same time, the race to meet a new minimum capital requirement by March 2026 is accelerating, with 1.7 trillion naira already raised in 2024 and another 900 billion naira expected this year. The big question is, can the industry balance resilience with profitability? Ayokunle Olubunmi, the head at Financial Institutions Ratings at Agusto&Co, joins me to unpack this. Ayokunle, it's nice to have you around.
Good morning, Lincoln. Nice to be here.
Of course. Now, with regulatory forbearance now gone, banks are bracing for impaired loans to climb to nearly about 7%. How do you see this affecting everyday lending, especially for small businesses already struggling with high borrowing costs?
I think the banks have already even reacted, right? Even before the forbearance was extinguished, right? What we've seen most banks done is to actually tighten their lending policy. Let's not forget that the banks are not immune to what is happening in the economy, and with the pressure and the challenges that we're having in the economy, we've seen the bank try to strengthen their risk management framework, because if they actually even onboard customers that don't have strong credentials, those can actually even aggravate the non-performing loan of the banks, right? So see the banks trying to even reduce the lending, right, in terms of the appetite for new borrowings. In addition, in terms of the funding cost, right, like I mentioned earlier, the banks are not averse to what is happening. What we've seen currently is the monetary authority is actually even having a tightening stance, right, with the MPR at 26% and even the CRR at 50%. So, of course, that would dovetail to the cost of banks and cost of operation for banks, and definitely the cost of funding will still remain elevated for the banks.
You talked about some cost-cutting measure as regards tightening of lending by the banks, but then would that not affect households and businesses that rely on this loan either to expand or for major purchases?
Because if you look at the performance of even the household and even businesses, in the last 2 or 3 years, their cash flow has been adversely impacted. And recall that the banks, for every loan that they're given, they need to be 100% sure, or to a reasonable extent, be sure that they can actually even get back those loans, right? They can recover those loans back, right? So what we have seen is that, however, it doesn't mean that the banks are not lending. But what I'm trying to say that the banks, what they're trying to do is to focus on the strong businesses, the big players, those that have been able to withstand various economic cycles that we've actually even seen, right? But I agree with you that some of the smallholder farmers, some of them will actually even, some of the SMEs will be, to an extent, be affected by the banks being careful in terms of who they lend to.
All right, now, the Naira lost over 40% of its value in 2024, and foreign currency revaluation gains are now tapering off. Now, if banks are protecting themselves through tightening of lending, are they also doing that to their customers? Because we're looking at the possibility of a currency shock going down, and what we need to protect the market ecosystem.
Okay. I think when you have, shall I say, changes in the currency, right? When you have either an appreciation or devaluation, depends on where you even find yourself. What we've seen the banks done over the last 3 years is to try and even sanitize their portfolio and even strengthen it further by ensuring that foreign currency loans are only given to businesses that have cash flow in foreign currencies. So what we've seen the industry has done is to learn from the mistakes made in the past, right? We learn from the lessons learned from around the 2014 devaluation that we had, the currency shocks that they have then. So what we've seen the banks now is to restrict the foreign currency loans to even those that actually have foreign currency receivables. Another thing that the banks are doing, particularly the big banks, is to try and provide hedging instruments, right, for most of their customers to also ensure that those also are protected from foreign exchange shocks. Some banks have also been offering advisory service to their customers to actually even re-emphasize the message that, look, if you don't have foreign currency receivables, if you don't earn in foreign currency, it's highly risky for you to be borrowing or to have liabilities in foreign currencies.
Now, a lot of people who don't have foreign currencies and they still borrow. So I wonder what the end goal will be for them if they're able to survive the crisis as it holds. But then let's look at this. In just 7 months of 2025, banks have issued about 750 billion naira in commercial papers. Is that a smart funding strategy, or could it end up raising the cost of capital in the long run?
Even if you look at the Nigerian financial ecosystem, you notice that the banks typically don't like issuing commercial papers, right? Because different people will interpret it differently. But the banks don't have a choice now. Like I mentioned earlier, the CRR rate is actually 50%. So effectively, for every deposit that you've raised, you can only use half of it. So that means that the effective cost of funding that particular deposit, cost of funding for that deposit is actually double. Right? Should I say, fortunately or unfortunately, commercial papers are not subjected to CRR, right? So what the banks are doing is to actually even pivot a bit to the CRR, such that at the end of the day, you want to look at the effective funding cost, right? It's cheaper compared to those deposits, right? So in terms of increasing the cost, in the near term, I don't think so. Right. However, as the economy stabilizes and then the CBN moderates the pressure, I think the banks will also even be reducing the appetite for CRR. But for now, it's something that is an existential thing that they have to do. They don't have a choice because you've seen their cost of funds climbing significantly.
We're actually talking about potential losses and with interest income under pressure as we see it. Do you think that digital banking, maybe fintech partnerships could become the main lifeline for Nigerian banks to actually sustain some sort of profits?
So let me correct something, right? Last year, we saw a significant surge in interest income from the banks on the back of the high yield on treasury securities, high lending rates, right? We saw that significant increase in interest income. As a matter of fact, last year was the first time since 2020 when we had an increase in the net interest spread for the industry. Your net interest spread is simply your net interest income as a percentage of interest income. And we think the trend will continue this year because all the capital raised, the banks need to deploy it, right? They will deploy it largely into investment security and the yields are high. So interest income will actually maintain an upward trajectory. The major issue will actually be the surge in impairment charge because of the absence of forbearance, right? You need to have adequate provisions, and some banks are accelerating provisions on some loans that they want to write off, leveraging the transitional reliefs that the CBN introduced. Having said that, in the last couple of years, we've seen a lot of banks focus more on fees and commission, particularly the digital channels, to see what they can get from it. For the digital channel, it's not only about income, it's also a way of even getting deposits, because you notice that what is happening, the culture that we are having now, the footfall in the branches is actually declining. Most of us prefer to consummate transaction from the comfort of our home through our phones or through our laptops. So what you see a lot of banks say is actually invest in those assets. Having said that, they realize that, look, the fintechs, that is their problem. That is something that they're actually even stronger. They are very agile, right? So a lot of banks have been partnering with the fintechs, and we think that will also intensify in the near term.
All right. Interestingly, in terms of partnerships now, 8 banks have already met the new capital requirement ahead of the March 2026 deadline. But smaller banks are still scrambling. So should we expect some sort of mergers and acquisitions as the weaker players try to survive?
Okay. I think we need to put this thing into proper perspective, right? The so-called small banks, if you first exclude, not in a discussion, let's first exclude those that are under, if I can call it the CBN ownership, right? The ones that CBN dissolved their board. If you exclude those ones, the relatively smaller banks, the implication of it also is that their capital requirement is actually even smaller. So while some big banks are still struggling to raise 300 billion, one of them are just trying to raise is even like 30 or 20 billion. And from all the banks, let's say from majority of the banks, what we've seen is that a lot of them are still in line with their capital plan, right? Because at the beginning of this exercise, all of them share their plan with the CBN. By this particular time, this is how much we'll raise this one, and we'll actually even raise that. In terms of merger and acquisition, during this process, we think mergers and acquisition will be quite minimal. except for the ongoing Providence Unity Bank that is already in public domain. But mostly it's going to be minimal. What we are going to see more, if push gets to shove, is some of them downsizing, meaning that scaling down on their license, either moving from national to regional, having a regional license. I know for a regional license, where you need a minimum bit of capital is 50 billion, right, which is relatively easier for them to actually meet up. Right, so we don't think we'll see a lot of mergers and acquisition. Having said that, in the next 1 or 2 years, we're going to see the impact of scale. So in which big banks are going to be making mega profits, right, while the relatively small banks might actually struggle. In that essence, we might now start seeing some mergers and acquisition. But based on this recapitalization exercise, we think mergers and acquisitions will be quite minimal for now. Having said that, a lot of banks have even, like I said earlier, they are actually in line with their recapitalization plan.
It does seem that we have some who are trying to hold their own in their own regards. Now, you talked about how all these moves and all these potential moves, rather, would actually result or affect earnings, so to speak. We understand that Agusto&Co projected that profit before tax will drop by 19.2% in 2025, with return on equity sliding to about 27.3% from almost 50% recorded last year. Now, how worried should investors be about this sharp decline?
Personally, I don't think investors should be worried, right? What we are seeing now is just a transition, and even the CBN trying to clean up their books, and even the banks are just trying to even clean up their books, such that by next year they will have a relatively clean slate. Like I mentioned earlier, the major reason for the decline will be the surge in impairment charge as a result of the forbearance that is expiring, right? Instead of even just providing and even keeping some of those loans on the books, some banks want to just make full provision, write it off. Some want to just accelerate the provision levels and write some of those bad loans back. The implication of it is that in the near term, from next year, the bank will have relatively clean book. And the beauty of it also is that by that next year, the banks also have a larger capital base for them to even do business. So it's just a short, right? Profitability might drop in 2025, but we see the industry rebounding with improved profitability and relatively cleaner books, right, by 2026.
Okay, fine. There'll be book cleanup, so to speak, as you said. But we've seen non-performing loans that was already at about 5.2% by the end of 2024. So if we begin to see banks who focus more on stricter lending patterns, how do you think that would affect the manufacturing sector and the agri sector?
Okay, in all of these sectors, right, like I mentioned earlier, it's not that the banks have stopped lending. What they're trying to do now is just only to focus on the relatively big players, because whenever we have an economic downturn, you see that the impact is much more on these relatively smaller businesses. But the bigger businesses with actually what significant history in the economy that have gone through various cycles, what you see is that those ones are likely to emerge stronger after those economic crises. So those are the ones that the banks are actually even focusing on. And should I even say, fortunately also, most of all those businesses are actually now in an expansionary phase, right? Having understood the various reforms, a lot of them are seeing how they can position themselves and how they can even expand. So the impact of all these big businesses will also will affect the man on the streets to a large extent, right? However, from 2026, when the economic gradually, because we've been seeing some level of stability in some of the economic variables, inflationary pressure has actually been declining, right? So to a large extent, right? And even you can see the exchange rate is already stable. So we think this trajectory will continue to 2026. And by 2026, we see a relatively more accommodative stance for the banks in terms of those that they actually even want to also lend to.
So you're saying the banks will focus more on the big companies. What are those big companies? Because when you look at the manufacturing and the agricultural sectors, they are also big in their strides. So what they're able to contribute in terms of production, in terms of GDP revenue. So are they not big enough that they would need some sort of recourse or financial positioning that can strengthen what they're able to deliver at the end of the day?
Yes, there's no way you can talk about the banking industry without even talking about the manufacturing sector. As a matter of fact, the manufacturing sector has been the second largest contributor to the bank's loan book, aside from the oil and gas sector. And if you look at this manufacturing sector, looking at that sector itself, we expect significant growth this year because some of these big manufacturing companies, a lot of them are trying to even expand their scale of operations now. Now that foreign goods are getting more expensive, a lot of us are buying locally or domestically produced goods, and some of them are even struggling to even meet their capacity. So we're going to see a significant disbursement to the manufacturing sector, albeit to the top players. In terms of the agriculture sector, let's not sort of forget also that you can also look at scale in this sector. Like there are the smallholder farmers, there are also the large agri processors, right? Of course, what we've seen in the industry is that a lot of banks shy away from the direct farming way because of the high risk there. But all the agri-processing businesses, a lot of banks have exposure to them and they are supporting them to expand their scale of operation. Because you can't talk about the Nigerian economy without talking about the agriculture sector. We account for roughly about over 20% of the Nigerian economy. And yes, the banks, they will still continue to support that sector. However, focusing majorly on the processing companies and then the large players in that particular segment.
And we hope that even while all these are being put in place, most especially by these financial players, the Central Bank of Nigeria and other regulators will also be looking at critical frameworks that can help the industry stay afloat possible economic shocks, more or less like a buffer on both sides. Thank you so much, Ayokunle Olubunmi, Head, Financial Institutions Ratings at Agusto&Co, for sharing your expert knowledge with us on the show.
Thank you, Legon.